Every so often, everything changes in the property market. Right now, in early 2025, we are at one of those moments. If you're a property investor, you need to know these 5 trends that are going to change the game in 2025. In this video, I'm going to go through how affordability is driving markets. I'm going to go through the migration slowdown and what it means for 2025 and 2026. I'm going to go through what is going on with building approvals and the housing construction pipeline so you know exactly how much supply is coming online. We're also going to go through lending and interest rate data. If you're interested in knowing what on earth is happening to the property market in 2025 and 2026 and positioning yourself to be one step ahead of the game, this video is for you. Let's go. Okay, so firstly, let's go through Australia's migration story. Now you can see videos everywhere. Just jump on the ABC and you'll see that we're talking about a migration and population crisis in Australia. We are bringing in too many people and we're not building enough homes to support them. That is pretty much a fact when you look at every chart about the housing supply and demand imbalance going on right now, and ask anyone in Adelaide, there's not enough homes there for the people that are coming in. As crazy as that sounds, all you have to do is go drive across your street and be like, but there's a house here, there's a house there, there's a house everywhere. Why don't we have enough of them? Seems like such a basic problem to solve in 2025, but it's a problem Australia has nonetheless. But what is driving it? In the year FY 2023, so we're going back a little while now, we had 518,000 people in net overseas migration, way above government estimates. The FY 2024 projection was around 400,000, 397,500 to be exact. But we have data for 3/4 of this year already. Population and net migration data is very, very lagged. We find out about it 6 or 9 months later. Don't know why. You can kind of work out who's coming in pretty quickly if you just look at airport data stats. But the official measurements come out 6, 9 months later. Perhaps the government doesn't want us to know. Crazy thought there. But if you look at the 3/4 of data, guess what? We've already just about blown through the full year projection that the government had. You think the government will be able to control almost exactly the number of people that come into our country, particularly when we're an island nation where people come in by boat or by plane and we can decide exactly the number of people that come in. And the government can do it. These people aren't, illegal entrants or anything like that. It's just people catching a plane, getting a visa, coming to our country. The government literally stamps the visa and lets them in. But we have a lot more people than what the government was projecting. That is another crazy fact about migration that's happening right now. But the government is all aware of this, and we have an election just a few months away, and one of the political parties are saying, hey, this is a big problem, we got to fix it. And the other political party's like, yeah, it's a big problem, we are fixing it. So this is a pretty massive trend for the property market right now. It's driven by our electoral cycle, and it means so much for property investors, and we're already seeing it. If you look at the rental data, and in particular, the unit rental data, which is driven by short-term migration statistics, you can see rental vacancy rates are going up. Rental prices are now coming down. What does that tell you? It tells you that the government's migration clampdown is starting to work. We are having a slowdown in migration, and you could see it in pretty live data, not looking at this old stuff a year ago, in live data when you look at the rental applications for these apartments where most of the new entrants go. So that's trend number 1. Number 2 we have here is affordability has collapsed over recent years. This has been the dominant theme. We've talked a lot about it on this channel, and everywhere you look, it's been the dominant theme. But it is about to turn around. For anyone in Sydney and Melbourne, that's time to go, yeah, finally, we're getting those interest rate cuts. And if this video is released it takes me a bit of time to actually release it and edit it, we may have already had one of those interest rate cuts. Don't really know exactly the timing of it, but most people are saying one is coming next week. And interest rate cuts are really the underlying driver of affordability measurements in these calculations. So affordability is at its roughest point right now, but it's about to start getting better. It'll be a slow incremental increase in getting better, but it will get better nonetheless. Here's what CoreLogic have to say about the size of what these interest rate cuts mean to affordability. Even with interest rates expected to drop, the impact may not be as strong as people think. A median income household could reasonably afford a $593,000 home, even with a 135 basis point cut. So that's 5 interest rate cuts. The median household can afford a home of roughly $600,000. That is still well below the current median value of $815,000. Now, she makes a good point. Affordability will improve, but guess what? It will still suck. Affordability will suck. It'll only get worse and worse over time. Unless interest rates get dragged really, really low again, affordability is gone in Australia. That's a concept that's just so 2020s, so 2000s. It's gone. We're past it. It's a conversation that's only moving in one direction. It is sad. It is a sad, sad reality. House prices aren't coming down magically, and incomes aren't magically going up. So we have a situation where that race is over. We're going to have this, even with 5 interest rate cuts, we're still miles away from the median income household being able to afford the median income house. That situation, I'd go so far as it will never happen again in my lifetime. The median income household will not be able to afford the median income house. That's a bit of a sad reality, but it's the truth. We're not even going to get close to it. So affordability will improve, but it will still suck. That's the summary. Next, we have one of the third and the biggest underlying shift in the property market. Let's not hide from the truth. Interest rates drive property markets. It drives changes, and interest rate cuts are coming. How many interest rate cuts are coming? I don't exactly know. Nobody knows, but I think the latest inflation data locks in 3 interest rate cuts. We're talking about February right now, but I'm pretty sure that this interest rate inflation environment is done and we are cutting rates. If you look through history, almost every single rate cut means 2 rate cuts. Some mean 3, 4, 5, 6, 7 rate cuts, and I believe this rate cutting cycle, we can bank 3 rate cuts in the next 6 months from the latest inflation data alone and from the next inflation report card that comes out in about 3 months' time. That still means affordability will be really bad, but it does change the numbers around substantially, and it is the biggest shift in property markets in 2025 that triggers all of the other ones that we're talking about too. It also means about a 7.5% increase in your borrowing capacity. If everyone that's out there can borrow an extra 50 grand, guess what happens to house prices, everyone? House prices typically rise by around 50 grand too. Interestingly, these reports also touch on lending policies too. And CoreLogic have some interesting words here. APRA, that's the lending regulator that decides how much people can borrow, is watching household debt levels closely. Basically, the lending regulator is looking at the total amount of housing debt that everyone has and how much of a mortgage people have at the moment. And they're saying that if borrowing spikes too much as rates fall, we could see new restrictions, like limits on high LVR or high DTI lending. Investors banking on easier loans should be careful. So what they're basically saying is that if interest rates come down, then the lending regulator could come in and be like, actually, you know that 50 grand increase in borrowing power? You know what? We're going to take it away. We're going to let you have the price discount. We're going to let you have lower interest rates, but we're going to make sure you can't borrow more money at the same time because we don't want house prices to rise. We've learned from our mistakes. We want to control house price growth a little bit more while interest rates are coming down because everyone's got too much debt already and we don't want people to take on more debt. Guess what, CoreLogic? I think you're a little bit off with this. I think APRA are just talking. I think it's just bluster. In fact, history tells us that when interest rates get cut, APRA comes in and makes another mistake and just says, you know what? We need more inflation. We need to inflate the economy. We need to get it going. That's why we're cutting interest rates. APRA, who say that they have this thing called counter-cyclical policy. That means that when rates go down, they start clamping the lending rules a little bit more to control house prices. No, they don't actually do that. When rates go down, they say, guess what, everyone, you can have more money too. That's what history has told us. They've done this a few times before. And to help the economy go, they are more likely to actually make it easier to get a loan than make it harder. If they do at the same time as interest rate cuts, we've seen this policy formula before in May and June 2019. If you see this same formula again in 2025, you can really put the jet burners on. You are hitting go to the property market, and I will post a video and I'll call it kaboom. If they do that, a kaboom moment is going to come like it did in 2019. We could be entering the same sort of zone as what they did then, now again. So, interesting one to watch and something to pay very close attention to in 2025. Next up, we have housing supply. And this one's obvious. It's too low. It's still too low. People are talking, they're in boardrooms, people in suits are there being like, let's build more homes. I've got this report, we need to build more homes. It costs this much to build a home, let's build more homes. More and more people in suits talk about it all the time. There's people in the media talking about it all the time. People are talking about it all the time. You know what it takes to build a home? It doesn't take any talking. In fact, it takes people to stop talking and to start shoveling and to start building and to start nailing things in and to start fabricating walls and put lights on. It requires people to actually do things. Talking isn't going to solve the problem. It's actually building, and our building numbers are not that great. In fact, it takes 50% longer to build a home now versus pre-COVID. 50% longer. How crazy is this? The world is getting more productive in just about every way, but to build a home, nah, let's take 50% longer to do something as basic as building a home. You'd think we would have figured it out by now. We've been building homes. Humans have been building homes for as long as our existence. I'm pretty sure when we were apes or whatever we started as, we were building these caves. We were there being like, here's some straw, being like, cool, build a home. Let's put it together. They could do it quickly. For us now, over the last 4 years, we are slowing down, doing it slower than ever before. That is ridiculous, but it's a reality that we have at the moment here in Australia. Again, another government failure. Perhaps it's the wrong people to blame, but if you're taking 50% longer to build a home, you've got to blame somebody. There's something seriously wrong with that. What we're going to see is a short supply of homes in 2025 and 2026. We're going to see approval numbers starting to increase, but the number of homes that are available in the market, it's not going to be enough. We're not going to be building enough homes. It takes too long to build a home, and we're not building enough at the moment. We haven't started enough at the moment, and it takes longer to build. Combine all of that, this thing's a little bit of a clusterfudge. That's the best way to describe it. Not good. Using some actual data sets here, CoreLogic have new home approvals are down 24% from the decade average and 30% below the Housing Accord's annual target of 240,000 homes. We are just not building fast enough. Yeah, no summary there. Anyway, there is some good news here. Building approvals. This is really the starting point. Whenever you build a home, it starts by getting a building approval. After you get a building approval, you then get a construction start. And then you actually get a construction completion. Now, I've developed quite a few homes, and I know this process inside out. So imagine the building approval numbers. This is where you start getting your planning deals in. You start getting your engineering reports, and you say, hey, I'm going to build something. Then you go lodge it to your DA or your CDC, certifiers, whoever you need to lodge it to, whoever can approve it. That, once it gets approved, is called an approval. Now, just because you have something approved, it doesn't mean it actually starts. We have about a 90% hit rate though, so it's a pretty good rate. It eventually gets started. It might take 5 years to start, but it eventually gets started. People have to go get loans, people have to get their funding, people have to get their finances in order, people have to do a whole bunch of things. Assume they do that, then they can start their construction. While I'm there, if you need help with a construction loan, my business, Flint Invest, knows a lot about helping people about how to build a home and how to get development finance as well. So if you're interested, jump in the comments below and you could find a link to speak to us there. Anyway, carrying on from there, once you actually start a home, it takes 50% longer to build that home than usual. The completion happens later. So we now have some positive news when it comes to approvals. They have definitely bottomed out. They bottomed out in about Q1 last year. So what we have at the moment is housing approvals have jumped 23% since March 2024. Unit approvals up 18%. But it's not nearly enough still. We need to keep increasing the number of approvals, because if we increase the top of the funnel here, then we'll end up getting more homes here at the bottom of the funnel eventually. It will take a little bit of time, but it is pretty important to actually get it happening. And finally, we have one of the last trends I just want to quickly talk about. It's property investors. I'm talking to everyone who's watching this channel. I'm 15 minutes into this video roughly now, and if you're still watching, you probably are a property investor or interested in property investing. If you're not, you're probably my mum, because she's the only one who watched for so long who's got no interest in property investing. Hi, mum. Anyway, what we have here is property investors are coming back. They've dominated the market through 2024, but it is changing around a little bit. My guess is, and I'm not sure about this, I'm thinking on the fly a little bit, is that property investors will weaken a little bit this year, and there'll be more owner-occupier demand as a percentage of the total market. The reason for that is property investors have been, jumping on the Adelaide bandwagon, jumping on the Perth bandwagon, on all these smaller markets that have done really, really well. That game, it's kind of ending up around now. Now, of course, people will still buy in all these markets, jumping in late into the cycle. But all these areas are up 50, 60, 70, 80%. People don't want to buy there anymore. Do you really want to buy in, Adelaide and get a 3.5% yield? You're going to pay tens of thousands of dollars a year to own a home in Adelaide, and you're probably going to be buying in a whoop whoop suburb in Adelaide too. That equation no longer makes sense. It made sense a few years ago when it was putting all this money in your pocket, but when it's taking all this money out of your pocket, you probably don't want to do that. So I think property investors will start shifting their numbers around a little bit and realizing the numbers just don't work anymore. They're not that attractive. They're all going to go to Darwin, and I keep harping on about it because it's pretty freaking obvious. You need to make your numbers work as a property investor. They're going to go to Darwin because it's one of the few places left where the numbers do work. But because the numbers aren't as attractive, I can see property investors coming down and owner-occupiers going up, even with rate cuts kicking in. A little bit of a shift in the dynamic here. We're also seeing apartments doing better than houses. That's another trend that I've touched on many videos and I've been talking about for a long time. So there you have it. You have my thoughts about how everything is changing right now, about how you should be one step ahead of the game and stop following the script that everyone is talking about. The script is changing. Be ahead of it by following these new data trends in 2025 and 2026 and realize right now we are at a pivotal point in the property market where things are changing. If you found this video interesting, do me a favor, hit that subscribe button and follow me along for my next one.